In this module, we will go over an example entitled Lucy and Ethel. If you go to Moodle, I suggest that you print out this example so that you have it in front of you. So we're going to do this in Excel. So the first part of this, Lucy and Ethel decide to go into business together. They are both board-certified dermatologists and record the following transactions. So here what we're going to do is record these journal entries. So Lucy contributes $60,000 and Ethel contributes $40,000 to start the business on January 1st. So here we need to do our debits and our credits. And so what is our debit going to be to? So we received $100,000 in cash, right? So cash is an asset. It's on the left-hand side. It increases on the left-hand side, and the debit is on the left. So here we are going to debit cash, $100,000. And let's just get these with commas, and we don't want any decimal points. And our credit is to what? So paid in capital. Now typically we would want to track them individually so we know how much each person's basis or their investment is, but for this purpose we'll just do them together. So Lucy and Ethel rent an office space for $2,000 a month, but they have to pay $6,000 up front, right? That seems pretty reasonable, where you pay first, last, and security. So remember from our problem theater on wheels, how should we treat this? So the rent for January would be an expense, right? And so what we would want to do then is record the rent expense. So here we have rent expense, $2,000. And then we have this first month's, last month's, and security. So security deposit would be just what it is, a security deposit, a deposit that we put down. So for us, would that be an asset, a liability, an equity, revenue, or expense account? Remember, those are our 5 choices from the balance sheet and the income statement. So what I hope that you think about that is an asset. So we would call that security deposit. $2,000. And last month's rent would be prepaid rent. Remember, rent it paid in advance. And then we would need to show how we paid for it, right? We paid for it in cash. So cash decreases by $6,000. Then they purchase supplies inventory, and they purchase office supplies. So I'm actually going to change this so they purchase with cash the supplies, but the office supplies with on account. So when we record the medical supplies, right, so this is to be used in future periods, so we would put that to inventory, medical supplies, and they purchase that with cash, right? $2,000. And then we have office supplies, which we can put to office expense, is $1,000. And that's on account. So that would be a credit to accounts payable. Here I would just want to move cash over a little bit to show that it's a credit. Next, they purchase a laser machine for $10,000 with a useful life of 5 years. And they pay for this with a check. So when they pay for a check, that's like cash, right? So here we're going to debit PP&E for $10,000. and we're going to credit cash $10,000. But the thing we have to remember whenever we purchase PP&E is then we have depreciation. And so here, our entry for depreciation is always depreciation expense, and we credit accumulated depreciation. So in order to calculate that, we have $10,000 times 5 years, right? So 10,000 divided by 5 is 2, and we're doing this for 1 month divided by 12, so it's $167, right? Go like that. So we're going to have 167 and 167. They see their first patients, and there were 30 of them, each for a fee of $500. So 30 times 500 is 15,000. 20 pay cash, and 10 will bill their insurance. So some pay cash, so cash increases by 10,000, and some will be their insurance, bill their insurance. So that's an accounts receivable. We're going to receive payment from their insurance, and that's $5,000. And we have patient revenue then of $15,000. They decide that there's a super duper facial peel cream on the market, and so they buy $1,000 worth, and they sell them for $25 a bottle, and they pay for the cream in cash. So this is going to be inventory $1,000, and we credit cash for $1,000. So this is where this is going to get a little bit different, that I want you to really pay attention. So at the end of the period, they only have 90 bottles. So what would that mean? So we started with 100 bottles, but we only have 90 left. So in our inventory, we have $1,000, but we now are 10 bottles less. So how do we take our inventory, right? So if this is our T account, and this is inventory. So inventory is an asset. Assets are on the left. So inventory is here, is $1,000, but we know that we have 10 bottles that were down, and they cost us $10 each. So 10 times 10 is 100, right? So we know that this has to be $900. So how are we going to get from 1,000 to 900 here? Well, we need something on this side, right? So we are going to credit inventory by $100. Now, what do we think happened to those 10 bottles? Let's assume for these purposes that they sold them. So if they sold 10 bottles, then we would have what? Well, we would have cost of sales, $100. So essentially what we're saying is that we had 10 bottles, we sold them for $25 a bottle, and we had the 10 bottles that cost $10 each, so that cost us $100. So in essence, we need to do journal entries that will show that we have $150 of income here. So here we have our cost of sales, which is this here. So what do we have yet to do? We have to record the sale of those bottles. So remember, whenever we sell something, we always have two entries. We have the sale, and then we have the cost of the sale. So we've done the cost of sale first. We usually do the sale first. In order to do the sale, let's assume in this case that they paid us in cash. So here we'll have cash at $250, and we will have sales of cream, or sales of sales. Yeah, I guess we can call it sales of. We'll just call it sales of $250. Okay, so now what we want to do, right? We have our journal entries here. We want to post our journal entries to T accounts. So we're going to do our T accounts on this screen, right? So I'm going to post them one by one. So here we have cash of $100,000, right? So I'm going to do plus, I hit the plus sign, go back over here, $100,000 debit to cash, and then we need our equity accounts, right? So we're going to have paid in, actually I'm going to create another thing here. So we have so here we'll have our paid in capital, and we know that's going to be a credit. So I hit plus, go back over to this one, paid in capital. Let's go to the next journal entry where we have rent expense, security deposit, prepaid rent, and cash. So let's start with cash, right? So cash went down. There's no reason I started with cash over something else, just stood out. Here we have rent. Rent is an expense, so we're going to put it in this column so you can see how I've organized this. These are our assets. When I first did this, we didn't have liabilities, so we're going to need liabilities. So I'm going to create another set here. So we have our assets, liabilities, equity, revenue, and expenses. So here we have our rent. We're going to get that back from over here. We're going to have our security deposit. Remember, a debit goes to a debit, so that's why I don't have to think too much here, right? And our prepaid rent. So you need a T account for every account that you're going to hit. Okay? So now we've done those two journal entries. Our next one is inventory medical supplies, right? $2,000. So let's go over here. This is causing me a little bit of trouble because of my recording thing is over here. I'm not able to get back to the... Okay, let's see if I decrease that a little, if that will do it. There we go. Okay. So we need our inventory medical supplies. So I'm going to create two different inventories. So this is inventory medical, because I want to keep it different than the cream. So inventory medical over here, and we paid cash. So we're going to take that out over here. Next we have our office supplies is a debit, and then we have a liability, right? Accounts payable, and that's going to be a credit balance, right? Liabilities are on the left, on the right, and so their balance is generally on the right. Next, we bought the laser for $10,000, and so we're going to have PP&E. Let's see, that's not working easily. We bought the laser for $10,000. So PP&E. And we paid for it with cash. So that's a credit. So we pick that up over here. We have depreciation expense. And we have accumulated depreciation. They saw their patients, so they got cash in the door. So we go to the next problem, and we have cash of $10,000. We got some of that was paid by insurance, so we have accounts receivable, but then we have to record all the revenue. So this is just back and forth, back and forth. Here we go. Then we bought the creams for $1,000, right? So that is in inventory. And we had cash that we paid for it by. $1,000. And then we sold some of the cream. So we had cost of sales, $100. And we took it out of inventory. And then we got paid for the sales. We created them, or we sold the goods. So we have $250 of sales. Sales revenue. Okay, so now we have our T accounts. So what I would like you to do is to, from this, do the balance sheet and income statement. So remember, in order to do that, first thing I would do is your income statement. Then I would close out temporary accounts. And who do we close them out to? Retained earnings. And then 3 would do your balance sheet. So here we will put retained earnings, right? So I'd like you to do that and post that to Moodle. I will create a new thing to post the class assignment to. And you will find this as Lucy and Ethel shell in Moodle as well. So you can use this Excel spreadsheet, and you could do those right here in this third tab. Any questions? Send an email or post questions to the forum.